Big move in Bitcoin then, in contrast to all the notes I wrote pre-show, which were telling me that this was going to put Bitcoin under pressure.
The narrative that perhaps this launch of these political meme coins will sap flows from Bitcoin is showing us that it's really not the case this morning. If anything, it's just accelerated the momentum and the excitement around cryptocurrency under another Trump administration.
Hi, Dewald. What is all this FOMO about? Should I buy Bitcoin now?
Are you smoking your socks? You should rather watch my show. You should rather watch my show.
All right, legends. Let's do another live stream, second live stream for today. What is going to happen here with Mr. Jerome Powell, right? The Fed interest rate decision in approximately, what is the time? 14 minutes from now. 14 minutes, we're going to get the interest rate decision, and then we're going to have the Fed press conference, which I'm going to attempt to broadcast live over here, right? It is here loaded already, so we can watch this all together to see how it impacts the price of Bitcoin. I'll put, the Bitcoin chart, and I'll put the speech, and we can all watch it together. I must say, guys, I'm not really a big fan. Let me just put the music ever so slightly lower here in the background. I'm not a big fan of trading news unless I see some magic at one of my levels that I'm currently watching at the moment. Okay, legends, so this is the structure that we have here to the upside. The lows, since we create, sorry legends, let me just do this. There's my gas heater ran out of gas and it's making funny noises, so I just had to switch it off. Welcome to the live stream. Remember to smash up that like button. Let me say hi to the community. Mr. Alex, go legend, welcome to the live stream. Huhit, welcome. Irina, great to see you here on the live stream. Dewald, I was sure that Dewald would delight us with another stream. Yes, yeah, I am. Mr. Jack, also die-hard supporter here of the channel. Always see you here in the comment section. Thanks so much for your support, and everyone that is watching currently live here at the moment. Remember, if you do want to make a comment, you have to be subscribed to the channel. Okay, so if you're trying to type comments and it's not working, you have to subscribe, and after 60 seconds you'll be able to make comments. Right. Even if you want to subscribe to unsubscribe later just to make comments, let's have some fun here in the comment section, right? Hello, Dewald. Welcome to the live stream. Mr. Max, Dewald, the legend is back. Guys, smash the like. Yes, remember to hit that like on your way in. Mr. Sockman, I think Sockman is part of our pro community, if I'm not mistaken. I've seen a similar name there in our pro community, but often people use different usernames for YouTube versus what they have in Discord and so forth. Right, Ablo, hi Dewald, welcome to the live stream. Okay, cool, legends. Now, okay, I think the best thing we can do over here is to have our levels marked out. The trading scenarios that we are looking at. Okay, one of the trades that I highlighted this morning actually played out, and some of the legends got into that trade. I'm not sure if you guys got into that trade, okay, and took profits to the downside because you can see the market is waiting. Okay, this is either going to turn out to be incredibly bullish, right? Because when I look at this structure here on the 2-hour time frame, so far I can see a nice little 1, 2, 3 Okay, is that the 4 and a 5? And we're going to get a nice pullback and continuation here to the upside, right? You can see the market is waiting because at the moment, based on the current price action, where we are right now with Bitcoin, you have a 3-wave structure, which is a corrective structure. So if you do not take this high successfully, okay, remember what we say about 3-wave structures, legends, right? When you form a 3-wave structure, the probabilities are very high to come and claim the low. 3-wave structure to the upside, price is now here. It's waiting for the interest rate decision. It needs a 4 and a 5. The retracement becomes very interesting to form a higher low for continuation to the upside. So can you guys see, like, the market is waiting? Is it going to give us that 5-wave structure, or is it just going to tank here to the downside, right, in a 3-wave structure? Because we all know what happens with damn 3-wave structures. But nonetheless, okay, let's go back here onto the price action that we have at the moment. We have 10 minutes left, so I'm going to try and not forget about the Fed interest rate decision. Let me put the ETH chart here as well, because I'm not sure if you guys are familiar with what I wanted to point out here on ETH. And most of the altcoins, look at where they are. Can you see it's waiting for a decision? They have all broken out of trend and they are now at the retest areas. ETH, Fetch, look at this. They're all retesting the trends that they broke out this morning. Link, and I'm sure there are many more. Okay, right. They have broken out in 3-wave structures and now they are retesting the trend. Is this the move that we are all waiting for? Right? On Link, on Fetch, on ETH, right? Are we going to get that breakout to the upside, or was this all just a fake out on all of these altcoins? So you can see the market is waiting for whatever is going to happen, right? It's either going to be the interest rate decision that's going to give us a little bit of action over here, or the magic is going to happen inside the Fed press conference. Right, Bitcoin is waiting. Okay, so you can see the market is at a critical level. Do we continue up? Right? Or was this just an 3-wave structure here to the downside, and you're going to come and eat up all of these lows on all of these structures? Just come and eat up all of these lows. Right? That is now the question. So very interesting to see what the market is doing just minutes before the interest rate decision. Okay? Is this a true breakout or not a true breakout? From a structural perspective, this is bearish. Okay, yes, you play the breakout, but look at this, you still have a lower high. So from a market structure perspective here on Link, you still have a lower high. So you need that push to the upside to create a higher high, right? You come down, you create a higher low, and you continue momentum to the upside. Fetch actually does not look bad. Fetch actually has higher highs, but it's lost support over here for some reason. Okay, but it's testing the trend beautifully over here. ETH. Okay, but you guys get the point, right? They are all at critical levels. And right, I just quickly want to jump here into the 5-minute. I just want to see what's happening. Oh, we're getting a dump here to the downside. Okay, is this the dump before the pump? Right, this is now the question. Is this the dump before the pump? I want to see what CVD is doing at the moment. Let me refresh this, because from what I'm seeing here, it looks bearish. It looks bearish. There's no sign of strength just as yet. Okay, kind of looks bearish. So from a bullish case perspective, what you would like to see is the following. Okay, if there's any hope for the bulls, if you're a bull and you believe we're going to go take the high, right, you want to see an ABC 3-wave corrective structure. You already have a potential 5-wave, well, 3-wave structure here to the upside. Let's zoom in here. Yeah, you took that low, right? So you have to count it from here. Unfortunately, legends, this at the moment is a 3-wave structure to the upside. At the moment. But it can also be counted. So for the bulls, what you want to see is a 1, 2, 3, 4, 5. Do you guys see the conundrum? Okay, so hopefully for the bulls, this is an ABC corrective structure. 3 is in, this is 4, and we go up for 5. 4 has an invalidation, by the way. 4 has a clear invalidation. Okay, when I take a fib from the low of 2 to the high of 3, okay, 50% Fibonacci needs to hold. Otherwise, no more fifth wave. Okay, unless this is a 1, 2, 1, 2, 3, 4, 5, double 1, 2 combo, the probabilities for the scenario is unfortunately a little bit low because of how large this structure is compared to this structure, because this is the main structure and it needs to be larger than this structure. It's not an invalidation. It does impact the probabilities severely. Okay. Right, and I'm a trader that trade probabilities. So we are hoping, okay, for the bulls to stay in control. It needs to be an ABC corrective structure where you have formed 1, 2, 3, 4, 5. Okay, the retracement will become very interesting, but it's never easy. It's never easy, legends, because I can throw a spanner in the works over here and even tell you, well, even if it makes a 5-wave structure, right, there's still a chance that you can come and claim the low, because nothing's ever guaranteed in the market. And, you know, this morning we discussed it here in the live stream. Well, why, Dewald? Why, if we make a 5-wave structure, can we still claim the lows? Because this can be counted still as an A, B, C to the downside. Okay? Inside of your A, you have a 3-wave structure, A, B, C, to complete your A wave. And then from here, you have an A, B, C to complete your B wave, because the B wave has to be a 3-wave structure. And your C wave over there, right, the C wave has to be 5 waves. So even if you make a 5-wave structure, you could still claim the lows. So it's never easy, but it's about getting into the trade at specific levels with good risk management and paying yourself on the way down. Okay, so some of the pro members, and I'm not sure if any of you took this trade that I highlighted this morning. Okay, so let me clean this up. Can take all of this out the way. Right, this morning on the 5-minute time frame, I spoke about it. Right, I spoke about it, and someone in the Legends Pro community, I can't remember the exact name, asked me, Dewald, they got into the trade, where do they need to put their TP2? They already took profits at the VWAP, okay? They already took profits here at the VWAP, right? And that trade was as follow. I took a fib this morning from the high to the low. I dragged it across, and I said, guys, this zone, do you guys remember? I can pull up the live stream, no problemo. Right? Do you guys remember I had this box in red and I said, right, that is where I'm expecting a rejection, because there's a chance that the high could be in. Right. I had 2 attempts, got stopped out at break even, didn't lose any money, you know, and I told the pro members exactly why I got into those trades and, you know, the importance of getting stopped out without losing cash. But keep an eye on the 786, because as long as you don't tap the 0.88, there's a potential that you're going to roll down impulsively. And some of the pro members, you know, I'm so proud of some of these pro members, got into the 786 using the swing failure line. Swing failure strategy, basically, okay? You get acceptance above, or you pierce the level, let me not say acceptance, you pierce the level, you start trading below, you enter. You put your stop above the high. VWAP becomes TP1, and then taking the low becomes TP2. And this is usually if I had to take this trade. Unfortunately, I couldn't take this trade. I was busy driving, went to go fetch my daughter from school. My alarm went off and I was like, shit, am I missing this trade? And then when I got home, switch on my PC. Yes, I missed the trade. Okay. Anyways, you can't catch them all. You can't catch them all. So I did not take the short, but I saw some of the pro members jumped into the short. TP1, TP2. This is where I personally would close the position. Okay. And, or not close, take majority of the profits. For me, my strategy would be I would take 90% of the profits over here and leave 10% open as a moon bag. That is how I would have traded this scenario if I was in the trade. 90% out, 50% out, 40% out, you leave 10% for lower levels. because this could form an impulse here to the downside. You just never know, right? Okay, cool, legend. So that is the trade that played out to perfection this morning. Right, now, okay, well, Dewald, you've now told us about the trade that played out this morning. I didn't get into the trade. What else? Okay, so now I want to zoom in. Where should I start? Okay, there is 1 minute left, guys. There's 1 minute left. Okay, let's just see what happens here with the Fed press interest rate decision. Let me go here to the calendar. Just make sure that I refresh that rate. Okay, it's coming. It's coming. It's coming. My hunch is it's going to stay exactly the same. Let's see. Right, let's wait for that to load. It's loading. It's loading. It's loading. Still a couple of seconds left. Hey, Mr. Andy in the house. Vamos. Welcome, welcome. The legend himself, Andy. Guys, I always talk about Andy, you know, myself and Andy doing the technical analysis. I see Andy is in the house. Mr. Andy, we're going to watch the Fed press conference here together in about 30 minutes from now, if I'm not mistaken. But we are patiently waiting for this number to come out, right? Let me refresh here again. It's not working. Come on. Give us the number. What is happening? What is happening? Right. Nothing burger. Right, nothing burger. Price keeps on dropping here to the downside. Man. But I think, you know, we all know, right? We all know. We get the dump. I've seen, you know, and I'm sure all of you have seen this happen as well. You get the dump, okay? The interest rate decision comes out, and then the press conference comes out, and then you start recovering back to the upside, okay? Retracing the entire move. The dump, and then the press conference brings it back to life here to the upside. So let's see if this is going to play out, because this kind of looks like a little bit of a contracting diagonal here to the downside. 1, 2, 3, 4, 5. ABC, boom, right? You just never know. Unless the bulls can step in here and hold the 50% Fibonacci. Hey, they need to hold this 50% Fibonacci. So far, the fourth wave is where it needs to be. Okay, it can still tap this zone over here, perfectly fine. Can still tap this zone. But if this is a 1, 2, 3, 4 in an ABC, okay, this is the zone that needs to hold for higher levels to the upside. What are the altcoins doing? Still retesting their trends. ETH still retesting, Fetch still retesting, Link still retesting. Okay, so maybe now everyone is waiting for the Fed press conference. Okay, so it really turned out to be a little bit of a nothing burger here at the moment. Right, legends, the most obvious trades that I'm watching here at the moment is, let's go to the 1 hour time frame. Okay, to the upside. Okay, let me switch on my stuff. I have a folder called stuff, and it's very important stuff, this over here. To the upside, we have very important resistance between $98,000, 376, and 98,000. Well, let's just call it 98 to 95. Okay, 98,500. This little zone, very important. Very importante. I don't know how to say that, Andy, in Spanish, right? But baie belangrijke. For the people that speak Afrikaans over here, Dewald, we hit the 618, then we take out Friday's highs, double zigzag for the B wave. Very interesting scenario. Very interesting scenario. Andy, it's also a scenario that I spoke about this morning. What if you have your 3-wave structure over here, okay, your corrective structure, and then another zigzag here to the upside. So zigzag up, corrective down, zigzag up, take out the highs, right? And then you form your B flat over here. Definitely an interesting scenario that I will be paying attention to. So yes, you know, you have an order block over here in confluence with the golden pocket. Does look great. Okay. Confuse everyone. You invalidate the fourth wave. But then you still pump to the upside. What happened? Dewald said we need to bounce at the 50%. Now we're bouncing at the 0.618. We took out the highs. Well, you know, it has to be said, Andy makes a very good point that if you find support here and you make a high, you can count this as a 5-wave structure, which is an impulsive structure. Okay, maybe the correction becomes bullish and you continue momentum to the upside. If you tap the golden pocket, then whatever moves up is a corrective structure, because you have 3 ways up. okay, you invalidated the impulsive structure and you can have 3 waves up again, right? B flat. Mu interessante. Hey, is that how you say it? Right, thanks, Andy. Mu importante. Yes, mu importante. Right, there we go. Remember to smash up that like button, legends, on your way in. And if you haven't done so already, and maybe you just forgot to hit that, that gentle tap over there. Okay, legends, currently getting a little bit of a bounce here to the upside. Andy, also, what is very interesting to me is that, you could also say, well, what if this was A in a 3-wave structure? This is B, and you still go down for a C in a 5-wave structure, because, this is something that I've just explained to the community. What if you have a 3-wave and an A? You have a 3-wave in a B, and this becomes A, B, C. Your C wave has 5 waves. It bounces here, it makes a 5th wave, right? And it falls, claims the low. It was a 5-wave structure. Why did we fall down? Well, the C wave is allowed to be a 5-wave structure. Okay, the one thing that bugs me, I just have to point it out. The one thing that bugs me a little bit about putting your A over there is that the B is incredibly short compared to the A. So if I take a timing fib from the highs to the low that we've created over there, okay, we have not, okay, let me take this Fibonacci here out the way. We have not surpassed the 0.382. So for your B, it would be very strange to pump, okay, maybe, before you hit the 0.382 and create a B flat. So you want the structure to still continue a little bit sideways. But if you move your A, and you count this as an A, B, C to the upside, then the timing makes sense. This high is exactly where it needs to be from a timing perspective, completing after the 0.382. Right, so legends, okay, let's quickly talk about some trading scenarios before. Okay, huge expanding ABC. Yes. Right, huge expanding. Something interesting, targets to the upside. I quickly want to measure some targets to the upside. Legends, we need to work out some trading zones over here. I'm just going to take this low for now, drag it across, reverse it to the upside. Let's just get our B flat targets ready to the upside. Okay, so the most common B flat targets is inside of this box over here. Okay, let's put a little box there so we can know, right? Between the 0.382 and the 0.236 is B flat targets, right? So let's put our boxy there, our rejection box. Unfortunately, B waves are incredibly difficult to trade because they have many targets. B waves are an absolute nightmare from a trading perspective because they have so many targets, right? You can have all your retracements when you take a fib retracement from the high to the low. It's the 50%, it's the 382, it's the 7, it's all the levels, okay? And then you also have the 1-to-1 extension, the 1.05, you have the 1.236, and the maximum target is the 1.382. It's very, very rare that I see a B wave, okay, a B flat tap the 1.618. This is usually an invalidation, and when I trade B flats that comes up all the way here, this is usually where I put my stop loss, because the B flat is not allowed to tap the 0.618. It usually invalidates a B flat, and then it's something else. Okay. Right, so legends, most obvious levels to the upside is these boxes that I've identified, okay? Also, when I switch on my levels, weekly levels, monthly levels, daily levels, point of controls, let's just rip out all the levels over here, okay? You can see the reason I have my red box to the upside is because we have a daily level and a naked point of control. Okay. So definitely an area that I will be paying attention to, that if for some reason during the Fed press conference price ramps here to the upside, okay, this is a zone where I'm going to be paying attention. I want price to pierce the level, get acceptance back below this zone, right? Stop goes above the high, and you starting to take profits when you start hitting support to the downside. Yes, there's a high chance if you get a successful rejection in this area that you could come and claim the lows. Never guaranteed, unfortunately, because this could turn out to be a bullish structure here to the upside. It makes a higher low, Okay, this becomes a 1, 2, 3, 4, 5 to the upside, right? So that's just what you need to do when you need to pay yourself to the downside. Ooh, it looks like we're gunning for that 0.618. Okay, and then definitely, legends, remember, you take your trend-based fib from this high to the lowest point over here, you drag it across, and this is where I get the box. So if you want to know where I get these levels from, there you go. Right, I will use these lines as SFP lines, and I have traded them very successfully. Okay, now, levels to the downside. Ooh, we are getting the dump. We are getting the dump. Legends, it's definitely possible, okay? Based on the structure that we've identified. If this is A, this is definitely a chance to be your B wave to the upside. A, B, C. Okay. A, B, C. But if that's it, I'm just thinking out loud here. If this is an A, B, C, you still need a fifth wave. That's the problem. That's the problem. You still need a fifth wave. Okay, but you at least have a three-wave structure to complete the B wave. Okay, so that is the one scenario that I'm looking at. Right, legends, to the downside. Okay, we have support. We have a naked point of control. Just want to move this ever so slightly here to the downside. Let's do this. Let's do this. Right. Just want to extend it a little bit to cater for price action. Currently falling here to the downside. Take a fib from the low to the high. Let's see. Okay. From that. Okay. Almost at the 0.618. I mean, okay. Right. Legends, for those of you that caught the short, yeah. Right, you now have your moon bag open here to the downside. Congratulations. Whoever shorted the 786 over here, well done. Right, I missed that trade. I was busy driving, taking my going to fetch my daughter from school. Right, only 50 likes, smashed. Only 50 likes, and we have over 170 people watching the live stream. I know we can do better than that. I know we can do better than that. Right, legends, providing you guys with pure technical analysis over here. I just want to make sure that I don't miss the Fed press conference, okay? Because we all want to watch that together and see the volatility happen here live. But we have to have our levels. I'm almost done. Legends, we have to have our levels marked out, okay? Like Andy also mentioned, you could have a three-wave up, a corrective structure down, okay? And another three-wave up, right? Golden pocket, we all know it's a very important zone, golden pocket, right? A little bit of an inefficiency over here. Okay, first area of support to the downside, which has confluence, is a naked point of control at $94,500. There is some support over here. These Fibonacci levels are a little bit standing by themselves, not real support in the zone. Okay, I like the highs that's providing support over here. Okay, you can see nice little highs over here providing support. You have a naked point of control. So, you know, from a bouncing area, this is where you need to bounce, right? Let's see. Let's see if it's going to turn out to be bullish here in the Fed press conference. Okay. Right, legends. Obviously, if this is an ABC to the downside, a zigzag here to the downside, the high is in. We got the rejection. For those of you that are in the trade, you know, you've got your moon bag running here to the downside. You know where to take profits here at the lows. To the downside, now I need to zoom out ever so slightly. Clean up the kitchen over here. Okay, let's go to the 2-hour time frame. I just want to look at this entire structure. Okay, I know it looks messy over here, but I'm trying to find some confluence. Okay, if this is the end of the structure in a 1, 2, 3, 4, 5, okay, you need, there's a couple of ways. Or you could say, well, you know, I'm just focusing on this structure. 1, 2, 3, 4, 5. Okay, and this is the ABC, the corrective structure for this structure. Okay, there's a couple of fib pools that you can use over here. First fib pool is, let me just clean up the chart. I just have to do this. It's irritating me. I don't like a dirty chart, right? You take your fib from the low to the high. The 0.382 has not been tapped since we made this high from this low. Okay, usually when you tap this level for the first time, you get a nice reaction. I've spoken about this multiple times this week. This is still a level that I will be watching. It's basically an SFP from these lows and grabbing all of the liquidity that has been building up here below these lows. Right, so if price had to continue here to the downside, definitely a zone where I will be paying attention. Stop goes below the low. I want to see price trade above my area of interest, okay? And as soon as you start hitting resistance back to the upside, you TP1, you TP2, and you TP your moon back, you TP out there when you start hitting the highs. Right, something very interesting I want to highlight also over here, okay, is that I see some people talk about the following, right? Only 50 likes. I've gone through that comment, right? There is another structure, guys, that I want to point out. 1, 2, 3, 4, 5. We could still be forming a larger fifth wave here to the upside. But now there's just one small change. This was the low. You formed a 1, 2, 3, 4, 5, and you had a running flat in an ABC. This is 1, this is 2, this is 3, 4, 5. Okay, I'm not going to count it into too much detail, but there's a chance that this is the third wave. And the reason I say that is because this move to the downside is awfully corrective and not impulsive to the downside. Okay, so regardless of what happens here, you could have now your third wave, you make an ABC in your fourth wave, and then you get another bounce to the upside to go and complete your fifth wave. So I'm just counting the structure here a little bit differently, where we used to count this as a 1, 2, 3, 4, 5. Okay, so there's a chance that you could still go and claim the highs, right, after you sweep up the liquidity below all of these lows over here. Right, from a trading perspective, for me it's very simple. Okay, when I put on my stuff, I have my support and my resistances to the downside. So if this is the fourth wave, still in formation over here, because this move to the downside looks awfully corrective, and the fact that we've tapped the 0.88 over there when I take a fib from the high to the low really decreases the probabilities to start forming impulses here to the downside. It still looks very corrective. Okay, and if this movement to the downside was an A wave, because once you make a top, okay, and the structure is complete in a 5-wave structure, your A wave needs to smash a little bit harder to the downside, because this entire structure needs to start correcting itself, and this is a very small A wave. So I'm just looking at the proportions of the wave to say that, well, what if, okay, I take my fib from this low to the high, and we are now busy with the fourth wave in a normal A, B, C, right? This is why this zone is so important. 0.382, 50% Fibonacci. This is where you want to form your fourth wave to go and claim the highs and potentially even go and hit $102,000. Right, and this area that I have for a fifth wave to the upside coincides with a macro 786. Okay, so I'm just trying to align the planets over here to say that, well, now if I go here onto the 4-hour time frame and I zoom in and I take a fib from this high to the low that we've created at $74,000, now you can see, well, why do I have that level there? Okay, it is the 786. Okay, you guys can see this is 786. I tried to highlight it, I stuffed it up. Right, cool, legends. So to the downside, I don't know how volatile it's going to get here with a Fed press conference that's going to kick in about 12 minutes. Okay, so most important level to the downside is this little 382 over here. I do like the 50% also, okay, with this little consolidation area. Okay, I do like that pivot. These are just some of the levels that I'll definitely be keeping an eye on. What we can also do is we can take a trend-based fib from the high to the low to the high. and you reverse it to get corrective structure targets to the downside from a FIP retracement perspective. Okay, so let's reverse that back to the downside. Ooh, very, 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 very interesting. Okay, I'm not sure. You guys that know Elliott wave theory by now, because I see some of the pro members are absolutely nailing Elliott wave theory, and some of them might even be better than me. Okay, right, legends. If this is the high, and this is an A, B, and it's going to fall down here in a zigzag structure, now we have levels to the downside that coincide with other areas of confluence. The first area is the 1-to-1 extension. Okay, you basically swing failure again from the lows, right? I do think that if price falls that far, it's most probably going to smash a little bit further, because the most common target is the 1.236. In perfect confluence with the 0.382, also in confluence with the support box that I have over here. And then, very interestingly, okay, the 1.618 aligns perfectly with the 50% Fibonacci. So there's a chance, okay, that you have your 1, 2, 3, 4, 5 wave structure in number 3. This is a 3-wave structure that's forming in number 4, and we are still going up for another wave to the upside. Just have to point that out. Right, and because this fall to the downside is awfully corrective, and this retracement went so deep, okay, tapping the 0.88, any movement down is potentially a higher probability of being corrective, and you're still going to come and claim the highs, even if you come down to this zone. Right, so purely from a probability perspective. Okay, cool. I think those are basically the levels that I'm watching here at the moment. Currently finding support here at the moment. Okay, we are finding a little bit of support. The market is waiting for something to happen. Let me take all of this out the way. Clean up the chart. Let's go back here onto what 15-minute time frame. Let's look at this structure. Okay, now we have our levels to the upside and we have our levels to the downside. Right, I mean, there is another structure. There's another structure. I'm sure some other people have spoken about this as well. I have spoken about it this morning. What if we end in a ending diagonal? 1, 2, 3, 4, 5, and we fall down, right? And then you create your 5-wave structure in an ending diagonal. 1, 2, 3, 4, 5. Okay, it's not a very common structure, especially if your wave 1 also started with a leading diagonal. Okay. So it's not common to see an ending diagonal and a leading diagonal in the same structure. It's very rare. Okay, so I'm not giving this scenario the highest probability at the moment. Okay, so we're currently finding support inside of my support box, which is great. Okay, we dip below, currently struggling here. So there's still a chance. You can see the market still holding on. Okay, double bottom for that 4th wave. Let's go. Yes. Right. Cool, legends. I just want to see if my feed is still 7 minutes left. The feed is pumping over here. I don't need the comments there on the side. Right, we can go and dive into this. Remember, guys, down in the description of this video that you're watching right now, or this stream that you're watching right now, is the best deals that these exchanges has to offer. It costs you nothing extra. You've got weeks. 20% of the money that you deposit in your features account gets airdrop back into your account after 3 days, right? You also get 25% discount on your trading fees. Okay, and you also have the chance, when you select this link and you sign up, you also have the chance to spin a guaranteed wheel that guarantees prices. Okay, the more volume you trade, the more times you can spin this wheel and win some guaranteed prizes. Right, wrong YouTube channel over there. And then for the larger traders, I know I can see from the analytics that, you know, Bluffin is for the larger account holders. Well, there you go, right? If you want a trusted exchange with extreme high liquidity, okay, that is climbing the ranks from a trusted perspective, Bluffin. The more you trade, the more money gets airdropped into your account. Absolutely stunning. So these links are down in the description, and this is where you qualify for the best deals that these exchanges has to offer. Right, also your way to support the channel. Okay, cool, legends. Let's now focus. Let's focus. What is going to come next? There are so many scenarios. I got the question earlier on. Dewald, there are so many scenarios that you speak about every day. How do you actually know which one's going to play out? You have to just watch the levels. Okay, so for me, I usually focus, sometimes I focus on the 15-minute, 5-minute time frame. The 15-minute is my favorite time frame to trade. But once I have my analysis done on the 15-minute, 1-hour time frame, I then jump into the smaller time frames to see, well, where are those specific areas based on the scenarios that I need to keep an eye on. Okay, so for me, it's very simple. If I can see in this local structure, okay, there's a 1, 2, and there's a 3. Okay, and that's a 3-wave structure. Probability so far is higher to come and claim this low, unless you take your FIB from the low of 2 to the tippy top over there, unless you can hold the 50%. Then it has a chance to make one more high. 1, 2, 3, 4, 5. If you tap the 0.618, usually I start looking for shorts very aggressively. If we hold the 50%, I can play a swing failure from the 50% Fibonacci, right? You dip below, you get acceptance back above, you enter, you put your stop above the low. Bam, right? You can even zoom out a little bit more. Here on the 1-minute time frame, now, this is now very degen. You can have your trend, right? There's always another way to get into a trade. You can have your trend. Okay, you might be saying, well, I missed this long. Okay, well, wait for the break of the trend. Wait for the break of the trend. Wait for some candles to close above. Okay, usually the retest is the best place to get into, like most of these altcoins are doing at the moment. Okay, and then you play momentum to the upside, taking profits at the high and maybe leaving a moon back open for higher levels. So it's always another way to get into a trade. I do like that there's some nice high volume kicking in here, but it is news related at the moment. Okay, right. So currently holding on to the 50% Fibonacci over here. So there's a chance, okay, to take the highs. Because we're holding the 50%. And here on the 5-minute time frame, we literally left a week behind. Nobody closed below that level. Did not tap the golden pocket. So you have a chance for a 5-wave structure. That is how I play probabilities. As long as we hold the 50%, I will play an SFP from the 50%. I will play an SFP from the 0.382. This box becomes a very interesting zone. If we tap the 0.618, that's maybe where my stop loss. If you're speculating on a 1, 2, 3, 4, you have your stop loss at the 0.618, speculating on a 5th wave to the upside, right? You know that the structure is not allowed to tap the 0.618. Okay, if you get stopped out, well, then you're going to start looking for shorts to the downside. Okay, but now we have to sit on our fingers and wait. What is Mr. Jerome Powell going to tell us, right? We have our zone to the upside. Okay, very interesting that if this is, let's just speculate here for a moment. How much time? We've got 3 minutes left. If this is the low of this structure, I can take a trend-based FIB from the high to the low, drag it across, reverse it to the upside, and now I have 5th wave targets. Okay. 5th wave targets are the 1.236 and the 1.382. An extended 5th wave here to the upside usually taps the 1.618. Beautiful. So the 5th wave targets are now aligning with the area that I am looking for a short. 1, 2, 3, 4, 5. Okay, it either makes a higher low and continues to the upside, or it takes the low, because this could be a C wave here to the upside. We don't know. This is why we pay ourselves on the way down. Leave a little bit of a moon back open for lower levels. Right, cool. Legends, remember to smash up that like button. Let's see if this has started. Here we go. Here we go. It's starting. Just want to see. There we go. Okay, cool. Just want to check if I can get the volume right over here. Almost. Let's go, legends. Let me go through some comments. When you executed swing failure pattern trade, how long do you wait for? Sorry, I just want to put my volume softer, yeah? How long do you wait for price to be above, below the level before you take the trade? Like 1 minute candle close, 5 minute. As soon as price trades, as soon as price trades below that level, I'm in. Okay. Sometimes I'll wait a little bit. It's such a, I've often told, Sindre, I've often told the people here in the live stream, it's such a difficult thing to explain to someone. But when you do it live, and some of the people have, we have been doing some swing failure patterns live trading, which played out to perfection. Okay. And then you know exactly, when you see it, you can see, okay, that's what Dewald looks for. It's very difficult for me to explain. I don't necessarily look at candle closes. I want to see the level pierced, and I want to see price move below it. That's usually a sign of weakness or a sign of strength, depending on whether you swing failing from the bottom or the top, short or longs. Okay. Why FIP retracement from the second wave? Because the structure is not finished. Okay. So if you're expecting a 5-wave structure to the upside, you have to take your FIP from number 2 to 3. Always. That's the rule of Elliott wave theory. They teach you that in Elliott wave theory. 4th wave, maximum target 0.5% Fibonacci. That is where a lot of people get it wrong. They take the FIB from the low to the high of 3. Okay, and then the FIB levels don't really make a lot of sense. Okay, it comes with experience, and it's all part of the theory. Okay. It's supposed to have started already. How much time? Let's refresh this. Okay, close this. Right, legends, we are waiting and in anticipation. We're waiting and in anticipation for the... Here we go. Right, let me do this. And now I'm going to keep quiet and leave you guys to listen. Because I also want to listen. Might make a joke here or there, right? What I want to do... Sorry, guys. What I want to do is this. Let's do this. How do I take this crap out the way? Just trying to figure out how am I going to do this. How am I going to do this? Let's do this.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Despite heightened uncertainty, the economy is still in a solid position. The unemployment rate remains low, and the labor market is at or near maximum employment. Inflation has come down a great deal, but has been running somewhat above our 2% longer run objective. In support of our goals, today the Federal Open Market Committee decided to leave our policy interest rate unchanged. The risks of higher unemployment and higher inflation appear to have risen, and we believe that the current stance of monetary policy leaves us well positioned to respond in a timely way to potential economic developments. I will have more to say about monetary policy after briefly reviewing economic developments. Pardon me. Following growth of 2.5% last year, GDP was reported to have edged down in the first quarter, reflecting swings in net exports that were likely driven by businesses bringing in imports ahead of potential tariffs. This unusual swing complicated GDP measurement last quarter. Private domestic final purchases, or PDFP, which excludes net exports, inventory investment, and government spending, grew at a solid 3% rate in the first quarter, the same as last year's pace. Within PDFP, growth of consumer spending moderated, while investment in equipment and intangibles rebounded from weakness in the fourth quarter. Surveys of households and businesses, however, report a sharp decline in sentiment and elevated uncertainty about the economic outlook, largely reflecting trade policy concerns. It remains to be seen how these developments might affect future spending and investment. In the labor market, conditions have remained solid. Payroll job gains averaged 155,000 per month over the past 3 months. The unemployment rate at 4.2% remains low and has stayed in a narrow range for the past year. Wage growth has continued to moderate while still outpacing inflation. Overall, a wide set of indicators suggests that conditions in the labor market are broadly in balance and consistent with maximum employment. The labor market is not a source of significant inflationary pressures. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Total PCE prices rose 2.3% over the 12 months ending in March. Excluding the volatile food and energy categories, core PCE prices rose 2.6%. Near-term measures of inflation expectations have moved up, as reflected in both market and survey-based measures. Survey respondents, including consumers, businesses, and professional forecasters, point to tariffs as the driving factor. Beyond the next year or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 4.25% to 4.5% and to continue reducing the size of the balance sheet. The new administration is in the process of implementing substantial policy changes in 4 distinct areas: trade, immigration, fiscal policy, and regulation. The tariff increases announced so far have been significantly larger than anticipated. All of these policies are still evolving, however, and their effects on the economy remain highly uncertain. As economic conditions evolve, we'll continue to determine the appropriate stance of monetary policy based on the incoming data, the outlook, and the balance of risks. If the large increases in tariffs that have been announced are sustained, they're likely to generate a rise in inflation, a slowdown in economic growth, and an increase in unemployment. The effects on inflation could be short-lived, reflecting a one-time shift in the price level. It is also possible that the inflationary effects could instead be more persistent. Avoiding that outcome will depend on the size of the tariff effects, on how long it takes for them to pass through fully into prices, and ultimately on keeping longer-term inflation expectations well anchored. Our obligation is to keep longer-term inflation expectations well anchored and to prevent a one-time increase in the price level from becoming an ongoing inflation problem. As we act to meet that obligation, we'll balance our maximum employment and price stability mandates, keeping in mind that without price stability, we cannot achieve the long periods of strong labor market conditions that benefit all Americans. We may find ourselves in the challenging scenario in which our dual mandate goals are in tension. If that were to occur, we would consider how far the economy is from each goal and the potentially different time horizons over which those respective gaps would be anticipated to close. For the time being, we're well positioned to wait for greater clarity before considering any adjustments to our policy stance. At this meeting, the committee continued its discussions as part of our 5-year review of our monetary policy framework. We focused on inflation dynamics and the implications for our monetary policy strategy. Our review includes outreach and public events involving a wide range of parties, including Fed Listens events around the country and a research conference next week. Throughout this process, we're open to new ideas and critical feedback, and we will take on board lessons of the last 5 years in determining our findings. We intend to wrap up the review by late summer. The Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Steve.
Steve Leisman, CNBC.
Now the fun
Thank
starts.
you, Mr. Chairman, for taking my question. A lot has happened since the last meeting. There's been tariffs put on, tariffs taken off, and meanwhile there's a bill advancing in Congress. And I just wonder if I could press you on the last part of your statement. Are you any closer now to deciding which side of the mandate is going to need urgent care first?
Well, so as we noted in our in our statement, post-meeting statement, we've judged that the risks to higher employment and higher inflation have both risen. And this, by the way, of course, is compared to March. So that's what we can say. I don't think we can say, which way this will shake out. I think there's a great deal of uncertainty about, for example, where tariff policies are going to settle out, and also when they do settle out, what will be the implications for the economy, for growth, and for employment. I think it's too early to know that. So, I mean, ultimately, we think our policy rate is in a good place to stay as we await further clarity on tariffs and ultimately their implications for the economy.
Hearing you describe what you're looking for in terms of being able to make a decision, it sounded like that's a long-term process before you sound like you're going to be comfortable, or the committee would be comfortable to act on what the data is telling you.
I don't think we know. I think, if you look where we are today, we have an economy that, if you look through, the sort of distortions in Q1 GDP, you've still got an economy that looks like it's growing at a solid pace. The labor market appears to be solid. Inflation is running just a bit above 2%. So it's an economy that's been resilient and is in good shape. And our policy is sort of modestly or moderately restrictive. It's 100 basis points less restrictive than it was last fall. And so we think that leaves us in a good place to wait and see. We don't think we need to be in a hurry. We think we can be patient. We're going to be watching the data. The data may move quickly or slowly, but we do think we're in a good position where we are to let things evolve and become clearer in terms of what should be the monetary policy response.
Nick.
Nick Timmeros of the Wall Street Journal. Chair Powell, there's naturally a lot of PTSD around 2021 and supply shocks, but there are some who argue that the current situation has notable differences. Energy costs are down, housing imbalances look nothing like they did 4 years ago, labor demand appears to be gradually cooling with wage growth running below 4%. What do you see right now that could nourish higher inflation beyond a rise in goods prices this year?
I think the underlying inflation picture is good. It's what you see, which is inflation now running a bit above 2%. And we've had basically decent readings in housing services and non-housing services, which is a big part of it. So that part, I think, is moving along well. But there's just so much that we don't know. I think, and we're in a good position to wait and see, is the thing. We don't have to be in a hurry. The economy has been resilient and is doing fairly well. Our policy is well positioned. The costs of waiting to see further are fairly low, we think. So that's what we're doing. And we'll see. The administration is entering into negotiations with many countries over tariffs. We'll know more with each week and month that goes by where tariffs are going to land, and we'll know what the effects will be when we start to see those things. So we think we'll be learning. I can't tell you how long it will take, but for now it does seem like it's a fairly clear decision for us to wait and see and watch.
So when you say that you don't need to be in a hurry, does that mean that could the outlook change in such a way that a change in your stance could be warranted as soon as your next meeting?
As I said, we are comfortable with our policy stance. We think we're in the right place to wait and see how things evolve. We don't feel like we need to be in a hurry. We feel like it's appropriate to be patient. And when things develop, of course, we have a record of we can move quickly when that's appropriate. But we think right now the appropriate thing to do is to wait and see how things evolve. There's so much uncertainty. If you talk to businesses or market participants or forecasters, everyone is just waiting to see how developments play out, and then we'll be able to make a better assessment of what the appropriate path for monetary policy is. So we're not in that place, and as that develops, and I can't really give you a time frame on that.
Janelle.
Janelle Marte with Bloomberg. So many economists have been pricing in higher odds of a recession, and several are noting that it is more difficult for the Fed to cut rates preemptively given the higher risks for higher inflation. So given the outlook, do you still see a path for a soft landing, and what does that look like?
Well, let me say, I mean, so let's look back and see where we are. So to go through 2024 up to the day, we've had unemployment in the low 4s for more than a year. We've had inflation coming down now in the mid to low 2s. We've had an economy growing at 2.5%. So that is the economy as we see it now. What looks likely, given the scope and scale of the tariffs, is that we will see certainly the risks to higher inflation, higher unemployment have increased. And if that's what we do see, if the tariffs are ultimately put in place at those levels, which we don't know, then we won't see further progress toward our goals. But we might see a delay in that. I think in our thinking, we never do anything but keep achieving those goals. But we would, at least for the next, let's say, year, we would not be making progress toward those goals. Again, if that's the way the tariffs shake out. The thing is, we don't know that. There's so much uncertainty about the scale, scope, timing, and persistence of the tariffs. So that's that. In terms of preemption, I think you can look back at the 2019 cuts as preemptive. I wouldn't say that what we did last fall was at all preemptive. If anything, it was a little late. But 2019, we did cut 3 times. But the situation was you had a weakening economy and you had inflation at 1.6%. So that's a situation where you can move preemptively. Now we have inflation running above target. It has been above target for 4 years. It's not so far above target now. And we have an expectation, conditional on what happens, that we'll see upward pressure on inflation. If you look at where forecasters are, they're all forecasting an increase in inflation. So it makes it, and then we've also got forecasts of weakening in the economy, and some have recession forecasts. We don't publish a forecast about that. We don't publish a forecast that assesses how likely a recession is. But in any case, it's not a situation where we can be preemptive because we actually don't know what the right response to the data will be until we see more data.
Colby Smith with the New York Times. How much weakness does the committee need to see, though, in the labor market and the economy more broadly to lower interest rates again? Is it about a certain increase in the unemployment rate over a period of time, or perhaps a certain number of negative monthly job reports? I mean, how are you making that assessment?
So first of all, we don't see that yet, right? We have 4.2% unemployment, good participation, wages behaving very well. Participation, I mentioned, at a good level. So, with the labor market, we would look at the totality of the data. We'd look at the level of the unemployment rate. We'd look at the speed with which it's changing. We would look at the whole huge array of labor market data to get a sense of whether conditions are really deteriorating or not. And at the same time, we'd be looking at the other side of the mandate. We could be in a position of having to balance those two things, which is, of course, a difficult balancing judgment that we'd have to make.
On that point about balancing, I mean, you've mentioned that the committee would consider how far the economy is from each goal and the time it would take to kind of get back to that point. But what does that mean in practice? I mean, how much of that assessment will be rooted in a forecast versus data dependence?
It would be a combination of the two. I mean, let's just say this would be a complicated and challenging judgment that we would have to make. Yeah, we're not in this situation, but the situation is if the two goals are in tension, so let's say that unemployment is moving up in an uncomfortable way, and so is inflation. Not the situation we're in, hypothetically, but we would look at how far they are from the goals, how far they're expected to be from the goals, what's the expected time to get back to their goals. We'd look at all those things and make a difficult judgment, and that's in our framework. It's always been in our thinking. We haven't faced that question in a very long time. So, again, difficult judgment to make, and not one that we face today, and we may never face it, but we have to be keeping it in our thinking now.
Edward.
Thank you. Edward Lawrence with Fox Business. So we had the CPI report that came out that showed month over month the first decrease in inflation in about 3 years. The jobs report, you said, solid that we saw. At the same time, we have those new tariffs that we're living under. So given this, should the Federal Reserve be cutting rates at all this year?
You know, it's going to depend. I think you have to just take a step back and realize this is why we are where we are. Is you know, we're going to need to see how this evolves. There are cases in which it would be appropriate for us to cut rates this year. There are cases in which it wouldn't, and we just don't know until we know more about how this is going to settle out and what the economic implications are for employment, for inflation. I couldn't confidently say that I know what the appropriate path will be.
So following on that, just so then how does President Trump calling on you personally, as well as the Federal Reserve, to make rate cuts affect your decision today and affect your job difficulty?
Doesn't affect our doing our job at all. So we're always going to do the same thing, which is we're going to use our tools to foster maximum employment and price stability for the benefit of the American people. We're always going to consider only the economic data, the outlook, the balance of risks, and that's it. That's all we're going to consider. So it really doesn't affect either our job or the way we do it.
Howard.
Hi, Howard Schneider with Reuters, and thanks for the time. I'm wondering, I mean, given the complexity about the first quarter GDP and what lies ahead, I'm just wondering what your intuition tells you about the underlying direction of the economy right now. Many of your colleagues have said they feel growth is slowing. If so, do you have any sense of by how much, to what degree the slowdown may be? What does your gut tell you about how things are evolving out there?
My gut tells me that uncertainty about the path of the economy is extremely elevated, and that the downside risks have increased. The risk is, as we pointed out in our statement, the risks of higher unemployment and higher inflation have risen, but they haven't materialized yet. They're really not in the data yet. So that tells me more than by intuition, because I think it's obvious actually that the right thing for us to do is we're in a good place. Our policy's in a very good place, and the right thing to do is await further clarity. And there's usually things clarify and the appropriate direction becomes clear. That's what usually happens. Right now, it's very hard to say what that would be. In the meantime, the economy is doing fine. Our policy isn't, it's not highly restrictive. It's somewhat restrictive. It's 100 basis points less restrictive than it was in, last summer. So we think it's in a good place, and we think the appropriate thing is for us to wait and see and get more clarity about the direction of the economy.
Well, let me press you on this idea of the economy being fine right now, because reading the Beige Book very closely the last time around, there was a lot of negative stuff, negative sentiment that was in there. And I know that everybody's looking at soft data right now. You mentioned it yourself that the sentiment's sour. But the Beige Book was talking about, the beginnings of layoffs in some industries, prices rising in some places, and an awful lot of investment decisions being pushed to the sideline. Doesn't that point to a slowdown?
It may well. It just hasn't shown up yet. And we all look at all these sentiment and read many individual comments just to get a better feel. And businesses and households very broadly are concerned and postponing economic decisions of various kinds. And yes, if that continues and nothing happens to sort of alleviate those concerns, then you would expect that to begin to show up in economic data. It wouldn't maybe show up overnight, but it would show up over weeks and months. And that may be what happens, but it hadn't happened yet. And also, there are things that can happen that will change that narrative. I mean, they haven't happened, but it's possible to imagine things that. But in the meantime, yes, we're watching it extremely carefully, like everyone is, but don't see really much evidence of it in actual economic data yet. And by the way, consumers keep spending, credit card spending. It's it's still a healthy economy, albeit one that is shrouded in some very downbeat sentiment on the part of people and businesses.
Michael McKee from Bloomberg Radio and Television. The Fed's been criticized recently by a former governor for what he calls mission creep. You take on more problems, use more tools, and then end up building tools to deal with the fallout of those tools, which then makes it a given that you will act more aggressively in the future. Is that a fair critique, and is that something you would be looking at in your framework review?
Sorry, say the critique again.
That the Fed has been involved in mission creep, gets involved in using too many new tools to deal with problems and to go too far. Is that something that the critique was based around the fact that you did QE and QE and QE and went beyond the narrow confines of your mandate?
So, well, I mean, there are a couple. That's not really beyond the confines of our mandate. Look, I would say this: we did things. Essentially, we're on an emergency footing for a couple of years in the pandemic, and it's very fair and very welcome for people to look back over what we did and say, hey, you could have done this better and different. And one thing we hear a lot is we could have explained QE a little better. We did think we were explaining it in real time. I completely accept the thought that we could have explained it better. There's a lot of thinking that we went on too long with QE. I can tell you that the reason we did was we were concerned that we didn't want a sharp tightening in financial conditions at a time when we thought the economy was still vulnerable. And so we did hold on for a long time to QE, and we, of course, tapered and everything. And then we immediately went into QT, and, you know, we're down a couple of trillion. But I get we certainly, with the benefit of hindsight, could have tapered earlier or faster. That's absolutely right. But this is all very welcome. You know, we knew doing this in real time that we weren't going to get it perfect, and those kind of after action kind of looks are essential, and we're doing the same thing in our review. So on some issues.
The other part of that critique is that you've taken on topics that are outside of the mandate, such as climate change and trying to ensure that certain groups are benefited by your economic policies in terms of employment, et cetera.
So, okay, on climate, you've heard me say over and over again that we will not be climate policymakers, and that our role on climate is a very, very narrow one. And I think that's what we've done. We've done really very little on climate. You can say that little bit that we've done was too much, but I wouldn't want to give any impression that we've taken climate and it's something that we're spending a lot of time and energy on. We're not. We have very, very narrow things. We did one guidance for the banks, and then we did a one-time stress analysis, climate stress analysis, and that's it. And we dropped out of the network of greening the financial system. So we didn't do much on climate, but I do think, and I've said this publicly several times, I think it's a real danger for us to try to take on a mandate like that, which is very narrow application to our work. And the risk is if you go for things that are really not in your mandate, then why are you independent? And I think that's a very fair question. I do think we've done a whole lot less on climate than some people seem to think we did. Anyway, that's what I think.
Should you have taken on the question of bringing unemployment rates down for specific categories?
We didn't do that. What we said was that we never targeted any unemployment rate for individual racial or demographic groups. What we said was that maximum employment was a broad and inclusive goal. And I think what we meant by that was we're going to consider the totality of the country as we look at our maximum employment goal. Of course, we were never going to target any individual group with that, but I think some people, wanted to hear it that way. But that's not at all what we meant. So that's just not a correct reading of our. But I can see how maybe people found that confusing, and we have to take that into consideration.
Jolene. Hi, Chair Powell. Thanks for taking our questions today. I'm Jolene Kent with CBS News. You've said wait and see, and the economy is doing fine today, but the impact of tariffs are already showing up at the ports, businesses big and small are telling us that they feel it, and most importantly, consumers say they feel it, that the challenges are here, and there's no waiting and seeing. For Main Street, what is the breaking point? What would have to happen to prompt a rate cut specifically?
Well, you know, so we really don't see in the data yet big economic effects. We see sentiment, there are concerns that higher prices may be coming or things like that. So they're worried now about inflation. They're worried about the, you know, a shock from the tariffs, but they really haven't. That shock hasn't hit yet. Okay, so, you know, we're going to be looking at the not just the sentiment data, but also the real economic data as we assess what it is we should do. And remember, there'll be two effects. One of them would be weakening economic activity, which translates into higher unemployment, and the other would be potentially higher inflation. Again, to say it again, the timing, the scope, the scale, and the persistence of those effects are very, very uncertain. So it's not at all clear what the appropriate response for monetary policy is at this time. And and by the way, our policy is in a good place, so we think we can wait and move when it is clear what the right thing to do is. Really not at all clear what it is we should do. So people are feeling stress and concern, but unemployment hasn't gone up. Job creation is fine. Wages are in good shape. You know, people are not getting laid off at high levels. You know, initial claims for unemployment are not increasing, you know, in any kind of impressive way. So the economy itself is still, you know, in solid shape.
Just a quick follow-up. President Trump now says he does not plan to remove you as chair. When you heard that, what did you think?
I don't have anything more for you on that. I've pretty much covered that issue. Thank you.
Chris.
Hi, thank you. Chris Rugaber, Associated Press. Well, I just wanted to follow up. Earlier, it sounded like you said it was unclear how the Fed, you know, what kind of interest rate decisions you will make later this year. So does that, you know, in March, there was guidance that 2 cuts might happen. You know, 2 cuts were penciled in for this year. Is that now, that guidance from the last press conference, has that been overtaken by events at this point?
You know, we don't do a summary of economic projections at every meeting, as you know. We do it every other meeting, and so this was the meeting when we didn't do it. And you know, we don't also kind of poll people, so I really wouldn't want to try to make a specific projection for where we are relative to that. We will, in 6 weeks, we had the June meeting, and you'll have another SEP. I'm not going to hazard a guess here today as to what it would be. Again, what I would say is that we think our policy rate is in a good place. We think it leaves us well positioned to respond in a timely way to potential developments. That's where we are. And that, depending on the way things play out, that could include rate cuts. You know, it could include us holding where we are. We just are going to need to see, you know, how things play out before we make those decisions.
Great. And just to follow up on that, I mean, when you address the issue of how the Fed would handle both rising unemployment and rising inflation, how are you thinking about the fact that addressing one could exacerbate the other? So a rate cut to reduce unemployment could worsen inflation and vice versa. How do you handle those challenges?
You just captured this is the issue with the 2 goals being in tension. It's a very challenging question. Now, there can be a case in which one goal is very far, one variable is very, very far from its goal, much farther than the other, and if so, you concentrate on that one. And frankly, that was the case. Well, it wasn't a case where they were really in tension, but if you go back to 2022, it was very clear that we needed to focus on inflation. The labor market was also super tight, so it wasn't really a trade-off. You know, I think you know what our framework document says. It says we'll look at how far each variable is from its goal, and also we'll factor in the time it would take to get there. So, you know, that's going to be potentially a very difficult judgment, but the data could break in a way that it's not. You know, I just don't think we know that. The data could easily favor one or the other, and right now there's no need to make a choice, and no real basis for doing so.
Victoria.
Hi, Victoria Guido with Politico. I wanted to ask, Congress is currently debating spending cuts alongside extending the tax cuts. And I know you've talked many times about how the path of the debt is unsustainable, but given that we're also talking right now about the economy slowing, potentially even recession, I was just wondering, is there a danger that spending cuts now could slow growth a lot more?
You know, we don't give Congress fiscal advice. They're going to do. We take what they do as a given, and we put it in our models and in our assessment of the economy. So I wouldn't want to, speculate on that. I mean, I think we do know that the debt is on an unsustainable level, on an unsustainable path, not at an unsustainable level, but an unsustainable path, and it's on Congress to figure out how to get us back on a sustainable path, and it's not up to us to give them advice.
Well, do you think that they should take macroeconomic conditions into account as they look at this?
I think they don't need my advice and our advice on how to do fiscal policy any more than we need their advice on monetary policy.
Andrew.
Thanks, Mr. Chairman. Andrew Ackerman with the Washington Post. In your Jackson Hole comments last year, you said you would not welcome further cooling in labor market conditions. The unemployment rate then was 4.2%, which is what it is now. Many forecasters now predict a higher jobless rate. How has your tolerance for weakening labor market conditions changed compared to a year ago?
So it was quite a different situation. What was happening last year is that over the space of 6, 8, 7 months, the unemployment rate went up by almost a full percentage point. And it was click, 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 click each month. And everywhere people were talking about downside risks to the labor market. At the same time, payroll job numbers were getting softer and softer. So there was a really obvious concern about downside risk to the labor market. And so at Jackson Hole and then in September, we wanted to address that forthrightly. We wanted to show that we were there we'd been there for inflation for a couple of years, and we wanted to show also that we're there for the labor market. And it was important that we send that signal. Fortunately, since then, the labor market has really, and the unemployment rate have really been moving sideways at a level that is, well in the range of mainstream estimates of maximum employment. So that concern has gotten a lot less. So, you're at 4.2% unemployment. I think we were in a very different situation. Now we have a situation where, the risks to higher inflation and higher unemployment have both gone up, as we noted in our statement, and we've got to monitor both of those. We actually have a potential situation where there may be a trade-off or tension between the two, potentially. We don't have it yet, and we may not have it, but that's what we have, and that's why I think it's a very different situation.
I guess I want to follow up by asking how much of a rise in the jobless rate you could tolerate.
Yeah, I can't give you I'm not going to try to give you a specific number. I'll just say we have to now be looking at both variables and which of them is demanding. If one of them is demanding our focus more than the other, that would tell us what to do with policy. If they're more or less equally distant and equally or not distant, then we don't have to make that assessment. The assessment is you wait. So I'm not going to try to be really specific about what we need to see in terms of a number. But if we did see significant deterioration in the labor market, of course that's one of our two variables, and we would look to be able to support that. You'd hope that it wasn't also coming at a time when inflation was getting very bad. And again, we're speculating here. We don't know this. We don't know any of these things. It's very hypothetical. We're just going to have to wait and see how it plays out.
Thanks.
Claire.
Claire Jones, Financial Times. In terms of getting some clarity, we've got some talks at the weekend in Geneva between the US and China. A lot of economists are attaching an awful lot of importance to what we hear from those talks. How much importance are you attaching to them in terms of judging what will happen to the US economy going forward? And just in a similar vein, some economists are saying it's days, not weeks, that we have until we start to put the US economy at risk of seeing the sort of pandemic-era shortages and higher prices if we don't kind of soothe relations between the US and China. So it'd be good to have your view on that too.
So, these are not talks that we're in any way involved in, so I really can't comment directly on them. So, but what I will say is this, we had, coming out of the March meeting, the public generally had an assessment of where tariffs were going, and then April 2 happened, and it was really substantially larger than anticipated in the forecasts that I had seen and in our forecasts. So, and now we have we're in a new phase where it seems to be we're entering a new phase where the administration is beginning talks with a number of our important trading partners, and that has the potential to change the picture materially or not. And so I think it's going to be very important how that shakes out. But we simply have to wait and see how it works out. It certainly could change the picture, and we're mindful of not trying to make conclusive judgments about what will happen at a time when the facts are changing.
And just on the fall in shipping volumes from China over these tensions, I mean, do you share that concern that we could start seeing goods shortages and higher prices in the coming weeks if this isn't resolved very quickly?
I don't want to get we shouldn't be involved even verbally in the questions about the timing of these things. Yes, of course we follow all that data. We see the shipping data, we see all that, but ultimately this is for the administration to do. This is, this is their mandate, not ours. And I know as you can see, they're again beginning to have talks with many nations, and that has the potential to change the picture materially. So we'll just have to wait and see.
Kosuke Takami with Nikkei. Thank you for doing this. The volume of imported goods increased significantly in the first quarter. Do you think that this situation could cause a delay in the impact of tariff on inflation? And does this mean that it will take longer time to reduce uncertainty?
The decision we made today? Which decision?
So the future decisions. So the volume of the imports, imported goods increased significantly. So the impact on the imported inflation may delay. So what is the impact to your future decision?
Okay, so I mean, I think we think that there was a big spike in imports, right? Very big, historically large, really, and to beat tariffs. And now that should actually reverse, so that it's the difference between it's exports minus imports. So and imports were huge, and so that it conveyed a very negative contribution to U.S. GDP, annualized GDP in the first quarter, as we all know. So that could, in the second quarter, be reversed, so that we have an unusually large contribution to usually positive. That's very likely as imports drop sharply. You could also have, very likely you'll have restatements of first quarter. It'll turn out that consumer spending was higher. It'll turn out that inventories were higher, and so you'll see those data revised up. It may actually go into the third quarter too, and so I think this whole process is going to a little bit make it harder to make a clean assessment of U.S. demand. I mentioned private domestic final purchases, which doesn't have inventories, government, or inventories, government. Anyway, it's a cleaner read on private demand, but that too probably was flattered a little bit by by strong demand for imports to beat tariffs. So that might overstate. It's a really good reading, 3% PDFP in the first quarter. That might actually overstate. So it's not really going to, I don't think it's going to affect our decisions. I will just say, though, that it's a little confusing, and it's probably less confusing to us than it would be to the general public as we try to explain this. It's complicated, and GDP is sending a signal, PDFP is sending a signal. It's a little bit confusing, but I think we understand what's going on. It's not really going to change things for us.
Courtney. Courtney Brown from Axios. I guess, we talked about some of the
indications of potential layoffs, price hikes, an economic slowdown, all being evident in the soft data. I'm curious why the Fed needs to wait for that to translate into hard data to, make any type of monetary policy decision, especially if the hard data is not as timely or might be warped by tariff-related effects. Are you worried that the soft data might be some sort of false warning?
No, I mean, look at the state of the economy. The labor market is solid, inflation is low. We can afford to be patient as things unfold. There's no real cost to our waiting at this point. Also, the sense of it is, we're not sure what the right thing will be. There should be some increase in inflation. There should be some increase in unemployment. Those call for different responses. And so until we know, potentially call for different responses. And so, until we know more, we have the ability to wait and see. And it seems to be a pretty clear decision. Everyone on the committee supported waiting. And so that's why we're waiting.
Just a very quick follow-up. There was this sort of vibe session, if you will, where the sentiments expressed in soft data did not translate into the hard economic data. How are you thinking about that when interpreting some of the signs in the softer survey data?
I think going back a number of years, the link between sentiment data and consumer spending has been weak. It's not been a strong link at all. On the other hand, we haven't had a move of this, speed and size. So it wouldn't be the case that we're looking at this and just completely dismissing it. But it's another reason to wait and see. You're right, though. We had a couple of years during the pandemic where people were saying just very downbeat surveys and going out and spending money. So that can happen, and that may happen to some degree here. We just don't know. This is an outsized change in sentiment, though, and so none of us is looking at this and saying that we're sure one way or the other. We're not.
Matt.
Thanks, Chair Powell. Matt Egan with CNN. So you mentioned earlier that you're monitoring the shipping data, and we have seen in the shipping data that imports from China into the Port of Los Angeles have plunged, and that has raised concerns about potential shortages. What tools, if any, does the Fed have to ensure that prices and inflation expectations don't get out of hand if tariffs do cause significant supply chain disruptions?
I mean, we don't have, the kind of tools that are good at dealing with supply chain problems. We don't have that at all. That's a job for the administration and for the private sector more than anything. What we can do with our interest rate tool is we can be more or less supportive of demand, and that'd be a very inefficient way to try to fix supply chain problems. But we don't see the inflation yet. We're of course reading the same stories and watching the same data as everybody else. And, right now we see inflation, kind of moving sideways at a fairly low level.
If I could follow up on that, President Trump has indicated that he will likely name a replacement for you when your term as chair expires next year. But your position on the board runs through January 2028, I believe. Would you consider remaining on the Fed board even if you're no longer chair?
So I don't have anything for you on that. My whole focus is on, and my colleagues' focus is all on, trying to navigate this tricky passage we're in right now, trying to make the right decisions. We want to make the best decisions for the people that we serve. That's what we think about day and night, and this is a challenging situation, and that's 100% of our focus right now.
Let's go to Jennifer for the last question. Chair Powell, Jennifer Schonberger with Yahoo Finance. Public records of your schedule so far this year show no meetings with President Trump. Past presidents Obama, Bush, and Clinton have all met with Fed chairs, and you met with Trump during his first term. Why haven't you asked for a meeting yet with the president?
I've never asked for a meeting with any president, and I never will. It's not, I wouldn't do that. There's never a reason for me to ask for a meeting. It's always been the other way.
So would you want to meet with him if given the opportunity to get more information?
It's never an initiative that I take. It's always an initiative I don't think it's up to a Fed chair to seek a meeting with the president, although maybe some have done so. I've never done so, and I can't imagine myself doing that. I think it's always comes the other way. A president wants to meet with you, but that hasn't happened.
And if I could just ask one question on monetary policy. When it is time to cut rates, how will you determine how far down rates will have to come to try to keep a balance on the inflation mandate as employment weakens?
I think once you have a clear direction, you can make a judgment about how fast to move and that kind of thing. So it's really the harder question is the timing, I think, and when will that become clear? And fortunately, as I mentioned, we have our policy in a good place, the economy's in a good place, and it's really appropriate, we think, for us to be patient and wait for things to unfold as we get more clarity about what we should do. Thanks very much.
All right, legends. Almost fell asleep. I had to act not to fall asleep. Wow, these political things are... Whew, right. What can I say? Thanks for watching this with me, by the way. A little bit of a nothing burger over here, right? The cookie and the magnet are still struggling here at the moment. Okay, I wanted to have a look at CVD, just see what's... can you guys see me? Right, let me just do this. Let me... Here we go. Hello there. Hello, legends. Hello. Sorry about that. I was just... I just wanted to talk to myself, okay? I didn't want you guys to hear what I was saying because I was just airing my frustrations with Mr. Jerome Powell. Okay. Dewald ended his vote. There we go. You guys can hear me now. You guys can hear me now. Right? You guys can hear me. There we go. There we go. Right. Yeah, he's back. I was just, guys, I was just saying the awfulest things about all of you and gossiping about Mr. Jerome Powell over here. So good that you didn't get that side. So basically, legends, what I highlighted over here is that I do see some bully CVD, local bully CVD building up over here. I'm not too convinced, right? You do have bully CVD building up over here, local on a double confirmation, might add. There's just no sign of weakness here at the moment, okay? If CVD was up here, I would have said, okay, this looks bad, but we still have bully CVD forming, even with the nothing burger that we got here from Mr. Jerome Powell. Okay. Right, legends, the battle between the magnet and the cookie, right, it basically just kept it balanced, okay? So not much else to discuss over here. I have gone through all the trading scenarios, the levels that I'm watching in summary, legends, in summary, okay? If price can hold the 50% Fibonacci, price can hold the 50% Fibonacci when I take a fib from the high to the low, right, which is now doing at the moment. If price can by some miracle hold the 50% Fibonacci, there's a chance that it can go claim the high and even hit the resistance box to the upside. If price comes down, taps the 0.618, you do increase the probabilities that this is a three-wave structure, okay, and it's going to start forming impulses back to the downside to come and claim the low. And this could potentially be the high for now. Right, so at the moment, the bulls are currently defending the level quite nicely from a larger time frame perspective, because I know I'm stuffing around here on the larger time frames. Let's clean this up. Okay. because I don't know what's going to happen during the night. Maybe the market needs to absorb the nothing burger, right? Maybe people like nothing burgers. Most interesting area of support to the downside is this little box over here, eating up all the liquidity below the lows. The structure to the downside looks very corrective, and the structure to the upside also looks corrective, which means after we created this high, there's a high chance that whatever happens over here, you're going to come and claim the high at some point again. Okay. This structure, okay, for this to form a 1, 2, 3, 4, 5, that is not an impulsive structure to the downside. I really struggle unless there's some other Elliott wave technicians that can help a brother out over here. But you tell me this is a 5-wave structure to the downside, it's very ugly. It really counts much better as a 3-wave, back to the upside. Okay, so in order to form a 1, 2, 3, 4, 5, to start creating impulses to the downside that could potentially even claim the $74,000 area. This is not how you want to start an impulse to the downside. Based on what I'm seeing over here, okay, yes, it's fine if we fall and we correct the structure ever so slightly here to the downside. Perfectly fine, as long as price still makes a higher low. Based on what I'm seeing over here, the probabilities are still higher to take out this high again before we claim these lows at the bottom. Okay, just purely based on the structure that I see over here. So people might be feeling bearish, prices dumping. Okay, so let's say, you know, this is the A, B, C. That's a zigzag, ladies and gentlemen. That's a zigzag. Okay, also when I take the trend base FIB to the downside, let's zoom into the structure. I'm just doing a quick little recap to show everyone how I do this. Okay, from the high to the low to the high, some very interesting levels here to the downside. 1-to-1 extension basically means another swing failure pattern from the lows. I do think that if price is going to come down again, it's going to come and eat up all of these lows over here because there's a massive liquidity pool that's building up below, right? The 1.236, very common retracement target. So if you're looking at a 3-wave structure, okay, very common, rare, but extended. And I have seen, we all know, I've made videos about the 1.618 level. Very powerful level. If price manages to get down to this level, pay attention. Pay attention, because this could be the end of the corrective structure and you make one more high to complete a 1, 2, 3, 4, 5. Okay. Right, legends, that is basically what I have for everyone over here. And remember, the best deals for the exchanges are always down in the description. Okay, it's also your way to support the channel, and where you get the best deals, lowest trading fees, bigger sign-up bonuses that these exchanges has to offer. Links down in the description, and it costs you nothing extra. Legends, have yourselves a great evening, morning, or afternoon from wherever you are, from around the world. I will see you guys in the next one. Thank you so much. Cheers for now.